Excellent. So welcome everyone. This is the Mega Psi Phi Fraternity Federal Credit Union series on wealth. We appreciate you guys being here. This is our first one out of the gate. So we're going to have a lot of fun with this. We're looking forward to our presenters giving us some good information. Everyone on here, I believe, are members or at least familiar with the Federal Credit Union and all the things that we've done in the past. A little background, we've been around since 1986 and it has grown over the years. We are currently operating out of the Atlanta area. And I want to acknowledge myself, who is the current president. And I needed to do that because I'm going to introduce you to say hello to you, the immediate past president, Norris Middleton, who's been serving us for, I think, a decade. And I've been working under his tutelage and guidance for a while. So Norris, if you would be so kind to say hello to everyone.
Hello, hi, Norris Middleton. And yes, Derek, you've been working for me for a decade. Okay, so you finally grew up and now you're the president. So it's all in your lap now. I really am looking forward to this series of the wealth series. This is something that we needed to do to let people know how the things, the tricks that they should have, not tricks, but the techniques that they should employ to, in fact, live a better life. And excellent. So with that, I will go on mute. And
no problem. So let me also introduce, there are three people that worked on putting this together. Charles Bruce, who's a director on the marketing committee, but directly involved with helping to pull this series together. Charles, would you like to say hello to the group?
Hello, everyone. And I hope you're strapped in because there's going to be a lot of information coming at you, like taking a sip from a fire hydrant. So buckle up.
Also, we have Andre Garner, who is not with us today, but he's been very instrumental in helping guide us through some things because he does this for a living in the marketing space. We have Davina Ware, who's part of A-Ware Consulting, and she is a marketing ad consultant. She's got 14 years experience in the business, and she helped us pull this together. So Davina, I'll give you an opportunity to say hello to the group.
Whoops, I was muted. Good evening, everyone. We are so excited to talk about this because, as we know, there are so many changes and lots of information out there about building wealth in this journey to wealth. And so this three-part series is really to get us thinking about where's my place within this? Where do I start? What do I need to do? And who best to hear it from than the family, essentially. I'm also a member of Delta Sigma Theta Sorority Incorporated since 2008. So I'm very passionate about how we can speak to our community about building wealth. And we have great experts here. I'm so excited to learn from them and glean from them, as will you. So through this, we'll save our questions to the end, but be thinking about next steps as we go through this process. Be thinking about home ownership in terms of wealth and what this means for you, your family, and of course the next generation. So feel free to put your questions in the chat and we'll make sure to relay those to the panelists, to our speakers tonight, to make sure they answer your questions, but also if you have questions about the credit union itself. So there's been a lot of talk about credit unions, as we know. One of our sister organizations has started one, but we got 37 years in the game. So we want to be able to present our expertise to you.
Thank you. Appreciate it. And it mentioned that I just became the president. Prior to that, I was serving for a long term as the treasurer, then the first vice president. And as we move into this next 4 or 5 years, I'm looking for the growth that we're planning. This webinar is one of those signature components I'm expecting us to start doing something with on a regular basis. We've grown our services for you, going digital, and we have some other things coming forward, but I will defer that for future communications that we will have. At this point, myself, Davina, and Charlie will be monitoring the chat and will respond accordingly as needed. Also, I'm going to allow Davina now to introduce our speakers, and then we look forward to having a great conversation. Thank you.
All right, good stuff. So we're gonna dig in here. Let me make sure my screen will be able to. Okay, so starting with a little bit of background, as we mentioned, the credit union has been around since 1986, and it's an opportunity for our members to have a place to put your finances, to grow from different options, and we have services as well. We'll touch on briefly, but if you have questions, save them till the end. And then, like I said, we are the first, I'm saying it as part of the team, not as part of the membership, but we're the first organization to start a credit union because there was a need and we wanted to make sure there was a place for Black dollars to go. The quick overview of the different services that we have, just to let you know what we have going on and if you have a need to take part of. We just did a really great auto loan promotion a couple of months ago. So, but those are all of the accounts there. You can find more on our website. So actually, I'll briefly just talk about our speakers who have so much experience in the banking and communication industry. But actually, I'm going to turn this over to you all to talk about Fifth Third Bank and partnering with us with this great initiative. And then I'll circle back on the next slide with high-level bio, and if you want to jump in.
Absolutely. I'll talk about this, Davina. Thank you. And thank you all for being here. Thank you for inviting Fifth Third to partner with the OPPF Credit Union in this series. In this inaugural event tonight, so Nigel and I are with Fifth Third Bank, and Fifth Third has been around for 165 years. And as the slide says, we've been listening to our customers and inspiring them with smart financial solutions aimed at making their lives in business a Fifth Third better. What our major aim is not only to be one of the nation's best performing regional banks, but to be the one bank people most value and trust. That's kind of the tagline that we go to market with. I sit in the Detroit market for the bank, and a small tidbit or an interesting fact about the bank: as a standalone country, the GDP of Fifth Third's retail footprint states would represent the world's third largest economy. We're in 11 states in the Midwest, all the way down to Florida. And we operate all of our businesses in those states, starting with our retail presence there. Back to you, Davina.
All righty. So let's give you a little bit more information about the gentleman that was just speaking here. So we have these two handsome faces here. We have Nigel, who's been silent, but he's going to jump in for a while, who's award-winning senior mortgage banker with Fifth Third Bank, has 20 years of lending experience. So any questions you have or throw at him, I'm sure he can catch them. Specializes in residential purchase and community lending to help specifically the underserved community. He's a finance guy. He's got his bachelor's from Eastern Michigan University, and has been a member since 2003. So happy 20th anniversary to you. And then the gentleman you just heard from is Jason, who serves as the Senior Vice President and Group Head of Community Business Lending for the bank. He has over 25 years of experience in banking and community, and he was very instrumental in helping the bank to establish the Neighborhood Investment Program. He has his bachelor's degree and master's degree in finance from Grand Valley State, and he's been a member since 1994. So you are coming up on your 30th anniversary. So glad to have you here and your expertise. I'll turn it back to you.
Thanks,
All right,
Davina.
thank you, Davina. Actually, today is my 20th anniversary
Oh,
of
wow.
pledging the fraternity, August 9th. So it's a
Oh, well,
special day.
congrats. And thanks for
Yeah, special
spending
day
it
for
with
me.
us.
Special day. Okay, so we're so happy to be here today and to partner with my fraternity, greatest fraternity on the face of the planet, to be able to bring this information to you guys, to help you guys to kind of see where home ownership fits in the wealth building process. So first thing we're going to do is just talk a quick little, kind of give you an overview of what we're going to discuss. So first thing is the decision. Is home ownership really right for you? It's right for some people, it's not right for others. So we're going to try to talk about that first and foremost. Then we're going to talk about some comparisons from renting versus owning, some pros and cons for the both. Then we're going to talk about the do's. We'll kind of walk you through the do's and don'ts of purchasing a home and how it fits into wealth building as a whole. And then last but not least, we'll talk about what's next, like what are the steps that you would need to take if you wanted to embark on, starting home ownership or purchasing that first house, to getting on your way to building wealth. So we can go ahead to the next slide. So first thing we'll talk about is owning right for you. We're going to talk about some advantages and disadvantages because that's what you really have to start. You have to have an honest conversation with yourself because then, it's not for everybody. So we'll talk about on the own side some advantages. It's an opportunity to build equity. When we talk about building wealth, which is what this whole series is about, equity is the portion. If you take the value of the home and you subtract what you actually owe on the property as far as the mortgage, what is left is equity. And that equity as a homeowner belongs to you. So if you bought the house for 100,000 and maybe you did a mortgage for 95,000, so you only put a little bit down, 5 years later, that home's no longer worth 100,000. It's probably worth 120, 130, somewhere around there. That extra equity, that extra 20, 30,000, that's your equity. That's something that you can tap into by utilizing home equity loans or refinances, things like that. So this is really ties into what we're talking about. Another advantage is you gain a sense of community. I can give you a real world example. I purchased my first home in 2004, and when I bought my house, we would always have a competition of who's got the best lawn on the block. You know what I mean? So we would walk into each other's lawn and say, I see a couple of weeds you got there, Bill. You need to clean that up a little bit. But it builds that sense of community, that sense of pride that you really can't replace. Your another advantage is you're free to decorate it and landscape it to your taste. We all know when you buy it, when you're in an apartment or you're in a condo or you're renting from someone else, you're limited as to what you can do to the property. Whereas, if it's yours, you can do the things that you want to do. You're not dependent on a landlord for repairs or maintenance. That's a double-edged sword, depending on because you figure if something goes wrong with the property, it all falls on you as the owner. You know what I mean? So if you so at 4 in the morning, that leaky pipe, there's nobody that you can call that's going to come. There's no maintenance man or anything that's going to call. You're going to have to make that call to the plumber. It all falls on you. So that kind of falls on both sides. It's an advantage and a disadvantage. Another advantage is potential tax benefits. When you own a home and you are financing that home with a mortgage, 9 times out of 10, and you'll have to check with your, each state is a little different, but the interest that you pay on that mortgage is tax deductible, a certain portion of that. So that can be a very important write-off for someone at the end of the year. Okay. Couple disadvantages in regards to owning a home. Once again, like I was saying, it's a double-edged sword. You're responsible for the maintenance. It all falls on you. You're also responsible for property taxes every year. When you own a property, you've got to pay, Uncle Sam's portion every single year. So typically we can roll that into the mortgage payment. So that way you don't have to pay it separately unless you actually you want to. And last but not least, disadvantage to owning can sometimes be you have less mobility compared to renting. So let's say if you have a job change and you're leaving the state or something like that. Well, if you're renting, you can kind of pick up, just break your lease, pay whatever penalty, and you're out of there. Whereas when you own a property, you actually have to make concessions for that home. Are you going to sell it? Are you going to rent it out? Are you going to sublease it? You know what I mean? That type of thing. So you don't have some of the mobility that you have when you're renting. Some of that, we jump to the renter side. Some of the advantages to renting: little to no responsibility for maintenance. You know, there's when you're renting a property, especially if you're like in an apartment or something like that, your snow removal is usually covered. Your lawn maintenance is usually covered. It's just sort of like you just come and go. You know what I mean? You don't have to worry about edging up the bushes or anything like that. And it is, like I said, quicker and easier to relocate in the event of a job change or some type of unexpected, life circumstance. It is easier to get out of a lease when you're renting. Disadvantages to renting: there are absolutely hardly any tax benefits. You can't write off any portion of your rent unless there are some circumstances if if you own a business and you work out of the home or something like that. But for the most part, there are no tax benefits to renting. You're not gaining any equity, and we'll talk about that equity piece a little later on down the road. And once again, you have no control over rent increases. You get that you get that letter in your mailbox that says rent is going up by $50 or $100. There's nothing you can really do about it. We can go to the next slide, unless you got something to add, Jay.
Yeah, I was just going to add, one of the other advantages is the sense of stability. Owning a home gives you and your family a sense of stability that you otherwise wouldn't have in a renting situation. I have actually heard of situations where a landlord can sell a property or lose a property, and you got no dog in that fight, right? You're just a renter. You could be kicked out due to no fault of your own. So home ownership gives you and your family a sense of stability that you wouldn't otherwise get with renting. Next slide. Thanks, Nigel.
All right, we'll hit the next slide, Davina. Okay, so this is given a 7-year comparison of renting versus owning. Now, keep in mind, there are certain assumptions that they're taking in regards to this, but it kind of breaks it down. So if you look at that top portion where it talks about the expenses from renting to owning. So you figure, if you look on the rent side, over 7 years, it's estimating you pay over almost $118,000 or so in rent over a 7-year period. They're estimating the renter's insurance for that 7 years to be about $2,500. So that's about $120,000 in expenses that you're over a 7-year period. When you're talking about owning, and like I said, they are taking certain assumptions here, and we'll talk a little bit more about those assumptions that they're taking. But you're looking at what your mortgage payment can total out to be for the 7 years, the taxes, the insurance, what's called your mortgage insurance, as well as the maintenance of the property. So as you can see, the total payments on the own side, in a lot of cases, especially now where rent has been astronomical, especially with the pandemic, a lot, and with interest rates being where they are a little bit on the higher side right now, the rental market is absolutely just going nuts as far as what some of these people are asking to rent these apartments out. And in a lot of cases, a lot of the people that I'm getting into mortgages or getting into homes, once we all the dust settles, they're saying, "Hey, Nigel, this payment's less than what I'm paying for rent, and I'm going to be in a better neighborhood." And I'm like, "Yeah, it makes a lot of sense for you." So when we talk about wealth building, this last little section at the end, at the bottom, is really kind of where the rubber meets the road when it comes to renting versus owning. So in the couple slides earlier, we were talking about building the equity in the home. Home values, I've been doing doing mortgages since 2001. Since 2001, we have only really had one major decline in the housing market, and that was around 2006, 2007. Other than that, home values have consistently appreciated in value. So what we're talking about here with this comparison at the bottom is we're talking about the mortgage, the rental payments of 120 some odd $1,000 over the 7 years versus owning keep in mind a portion of that interest that you're paying every year is tax deductible. So that tax savings is calculated, when we're talking about the difference between renting and owning. That's money, that's 16,261. That's money that you could have invested somewhere. You know what I mean? Whether it's in a money market or maybe you've got an investment account where you kind of play in the market a little bit or something like that, or with little stocks and bonds, things like that. This is money that you can immediately put to work for you. And then the biggest piece is the appreciation of the home. So like I said, if you buy a house, 7 years ago for $100,000, you buy in a decent neighborhood, that neighborhood continues to flourish. 7 years later, that house isn't worth 100,000. It's worth 160, 170. That extra equity is yours that you can tap into. And when I tell you, people tap into that equity all the time for different things like debt consolidation to get rid of those high interest credit cards. They tap into it to do for investments. I get people all the time that say, "Hey, Nigel, I've got a lot of equity in my home. I want to take a little bit of cash out to do, X, Y, or start a business," things like that. A lot of times people use the equity in the property to be able to jumpstart whatever endeavors that they want to pursue. So then it talks about if you decide to sell the home. Of course, if you sell the home, you pay off that old mortgage, and the equity in the home is yours in the form of and then it's actual tangible cash. So you can either have it as tangible cash upon selling the home, or if you want to access the equity with maybe a home equity line of credit or something like that. I'll give you a perfect example. In my case, I've been fortunate. Like I said, I purchased my home in 2004, worked really hard, was able to pay my home off. And as a result, when I wanted to start a business, where I said, "Hey, you know what? I live here in Detroit, Michigan, where, you can buy homes relatively inexpensively, fix them up, and then rehab them and sell them." I was like, but I don't want to have to dip into my 401k, or I didn't want to have to dip into any type of instrument that I had that's currently earning money for me. So what I said is, you know what? I'll do a home equity line of credit. My home equity line of credit allows me to pull cash away from the equity of my home to purchase this new property, to fix the property up. And then when I sell the home, I replenish my home equity line of credit and do it all over again. So these are perfect examples of exactly how your home can help you to build equity. I mean, to build wealth. Jay, you want to chime in at all? I see you shaking your head. I see you agreeing with
Yes,
me.
man, I love this slide. So
Mhm.
when you look at this slide between rent and own, think about on the rent side of this equation, the difference between that 120,000 and that 96,000 is the profit or the wealth building that your landlord is doing for renting you that property, right? So somebody's building wealth here. In the renting space, it just ain't you, right? You're
Gotcha.
actually helping your landlord to build wealth. So if you look at this slide, just from that perspective, the savings, all in on the owning side, even with paying taxes, you're paying less than you would if you were renting, because you are also paying your landlord's profit.
Mhm. All right, we can go to the next slide, Davina. So we'll talk about some of the do's of buying your first home. So the first thing that you want to do in the event that you guys do decide to do something like that and you don't own a home just yet, first thing you want to do is get yourself pre-qualified for a loan. That's where you talk to a banker like myself or another mortgage banker, and we actually sit down with you, or on the phone, and we actually gather some information from you to kind of get you pre-approved to purchase a home. What this does is by getting yourself pre-approved and getting a pre-approval letter, it tells the buyers that you are a serious shopper. A lot of times when people list their homes for sale, they won't even show their homes to people who have not been pre-approved or pre-qualified to purchase a home. It tells the seller that you're serious. It also lets the seller know that you have the backing of a reputable lending institution behind you that says, hey, he or she is qualified, they're ready to go, and we're ready to jump at a moment's notice. It also can let you know what you can afford before you start shopping. A lot of times when people come to see me, they want to purchase a home. I say, okay, sounds good. What are we looking at as far as purchase prices? What are you interested in? And they say, you know what, Nigel, I like this particular area. Homes are going for XYZ, but I don't know if I can afford that from an interest, I mean, from a monthly standpoint. I said, well, hey, let's gather some information. Let's figure it out. So it helps you to be realistic within your search because it lets you know, hey, this is what you can do and this is what you can't. Another you want to be realistic about your needs and wants. Think about how long you're going to be staying in the property. So that's really important. You have to be able to, when you're looking to purchase your first home or any home, you want to take an honest inventory of separating your needs from your wants. For me, I've got two girls, 8th grade and 10th grade. So of course, for me, school systems is a big thing. That's a need as opposed to a want. You think about that, big backyard with a pool. I mean, it'd be great, but that's more of a want at this point than it is a need. So you want to be able to kind of separate that to give a clear view to your realtor as to what they should be looking for you in a first home. And you, like I said, you want to clearly communicate those needs to your agent. If you got anything to add, Jay, jump in. If not, I'll go to the next slide.
Nope, nothing to add here.
All right, let's go to the next one, Davina. Okay, so we're going to continue talking about the do's of buying your first home. You do want to shop for a loan. All mortgage lenders are not created equal. They absolutely are not. Even though most of us get our money from the same place, that being Fannie Mae or Freddie Mac, the federal government. Even though we all get our money from the same place, and rates are determined by and large by the bond market, there still is a lot of differences between lenders. For instance, right now, Fifth Third, we've got a ton of what's called down payment assistance programs. These are programs that help people with money to pay their down payment or help with their closing costs. All lenders do not have that particular type of program. So that's why it does make sense for you to do a little shopping when it comes to for your mortgage. Understand that the best loan program for your personal situation may not be with the particular bank that you currently bank with. So that way you have to be prepared, even though you may bank with XYZ company, maybe these guys over here have a better program that meets your particular needs. And you want to search, when it says here, you want to search for the most competitive rates. You got to be careful when it comes to that, because you do have some lenders that can be a little tricky. They can offer a lower rate, but their closing costs are absorbently higher than the other lender that you may have been looking at. So you want to not only look at rates, but you also want to look at closing costs. That is very, very important as well. Another get your finances in order. You want to gather things like your last couple years tax returns, your last couple months bank statements. Take a look at your credit report. If you haven't seen your credit report before, you can go to places like Experian.com, freecreditreport.com, and you can pull a credit report. So that way you can see what's on the report. If there's any potential issues, you can knock those out. Hopefully you can knock those out before you even talk to your lender. You also want to learn about home buying programs. So that's exactly what I was telling you about a couple of minutes ago. There are so many state and local home buying programs that are offering assistance right now to a lot of people. But if you don't take the time to educate yourself, or you don't align yourself with the right mortgage banker, you'll never find out about those programs. A perfect example, me and Jason, we're actually, home base is Detroit, Michigan for us. Detroit just rolled out a program that gives up to $25,000 to go towards the purchase of a home in the city of Detroit. Think about that, 25 grand. I've been doing this for a long time, and they've never had a program that is this generous. But like I said, if you don't line yourself up with the right people, you'll never find out about those programs.
Hey, Nigel,
Dave, you got to, yes.
here, I wanted to sneak in a plug here because you were talking about credit report, and some of the people on the list may be aware, but we recently engaged another organization or financial group to work with us, and you're allowed your credit report, no charge, one time within a 12-month period. But this program called Balance, and if you go to our website, OPP FFCU, and search on Balance, it'll take you to another website, and is branded for us, and it's free to all of our members. And well, in fact, it's free to all of the Omega Psi Phi fraternity members, as well as the credit union members, where they will analyze your credit report for you, because that was one of the services that we're offering. So I didn't want to miss the opportunity to bring that up. We did promote that a couple of months ago, and we're looking at trying to do something later on, but it's important that if you haven't done that, you can get your credit report for the 3 people that you just mentioned, and this Balance organization will help analyze it for you at no cost.
Huge. That's huge. Because like you said, the more you know, the farther you'll go. All right, we'll go to the next slide, Davina. Another do of buying your first home. You want to use a real estate agent. Real estate agents, are licensed professionals that are trained to be able to work, not only try to find you the best home to meet your particular needs, but also in negotiating the purchase price of the home, negotiating certain terms of the property. And for a lot of people don't realize, for a buyer, your real estate agent is free of charge. The seller is the one that pays all the fees or the commissions to both realtors. So it's free for you. So you absolutely definitely want to get yourself a real estate, align yourself up with a real estate agent. You can ask friends and family for a referral. Most, family that's done it before usually will tell you, oh, I got a good guy or I got a good gal that can help out. You want to seek out experience, commitment, and full-time status. There are some, good part-time realtors out there, but a lot of times, if they're part-time, it usually means somewhere on, they've got a full-time gig somewhere else that gets the majority of their time and their commitment. Whereas if you're dealing with a full-time realtor, usually those guys are on it 24 hours a day. Real estate agents know the market inside and out and can help you to navigate your local market. So a lot of times, if you're new to a particular area, or you're wondering if purchasing in a particular area is a good investment, these local real estate agents, they've got their eye on the market 24 hours a day, 7 days a week. So they can tell you the hot areas to buy in, the areas to avoid, so they can be a really invaluable resource to you, absolutely free of charge. Because like I said, they don't get paid until the loan closes, or until you purchase the house, and that comes out of the buyer's proceeds. Real estate agents represent your best interest in have access to a lot of listings or properties, and they can help you to schedule showings and work for you in the negotiation. So exactly what we were talking about. When you're going into negotiating for a particular property, let's say if the home has been on the market for a while and they're asking $200,000, if it's been on the market for 3-4 months, that means it's kind of, in our terms, it's kind of gone cold a little bit. So you don't have to come in maybe with a full price offer. You can come in with a little bit of a lower offer because maybe they haven't, they're a little bit anxious to sell. You would only know that by dealing with a particular, dealing with a realtor. So they can help you with those negotiations. You can interview, several real estate agents to kind of determine the best fit for you. What I find is most of the time, a good referral from a friend or a family member, or even your mortgage lender. When you get yourself pre-approved, you can ask them, do they know anybody? All right, so you can go ahead. We can go to the next slide. Okay, we're keeping up with the do's. Hire a home inspector. A lot of people confuse home inspection with appraisal. They are two totally different animals. An appraisal represents us, the lender, me as being the lender, being Fifth Third. What they're going to do is they're going to take a look at that house, and they're going to compare it against other homes in the area that have recently sold to see if this purchase price is where it should be. If it lines up with, what other homes in the area are. A home inspector is the person that's going to take a look at that property with a fine-tooth comb. The home inspector is going to be doing things like checking the foundation. They're going to be looking in the attic. They're going to be the ones doing the termite test to make sure you don't have any termites. They're going to be checking the hot water heater to make sure it's not going to blow up on you 2 months after you buy the property. They're going to check the age of the roof to make sure, when you get in there 2 months later, it's not raining on your head. So a home, for most of us, a home inspection, the property, purchasing a home is the largest investment that you're going to make. You always want to take the time to spend that extra couple $100 to get a home inspection so that they can take a look at that home with a fine-tooth comb and tell you anything that could potentially be wrong with it. Consider hiring a real estate attorney. Real estate attorneys, depending on the state, sometimes real estate attorneys are required. Here in Michigan, for instance, we're not an attorney state, so it's not actually required. But a real estate attorney can be a good second line of defense to make sure your best interest is maintained. Request a seller-paid home warranty. Sometimes when people are listing their homes for sale, they'll throw a home warranty in there to kind of sweeten the deal, to get people interested in making offers on their home. What a home warranty does is usually it protects the major appliances inside the home for the first year of ownership. So if the water tank goes bad, or if the furnace goes out, sometimes that home warranty will either repair or replace that particular large appliance, which could save you thousands of dollars. Jay, if you got anything to add, I'll go ahead. If not, I'll jump to the next one. Okay, we'll go to the next slide, Davina. Okay, the do's and don'ts of buying, the don'ts of buying your first home. So we'll just kind of go through this real quick. You don't want to rush. Take your time. Sometimes people fall in love with the first house that they see. Take your time. Believe me when I tell you, if you don't get the first one that you fall in love with, wait a little while. Your realtor will show you some other ones that you'll be just as interested in and just as enthused about. Don't negotiate contracts without your real estate agent. That's what they're there for. You don't want to buy more than you can afford to pay on your current salary. A lot of times people get in trouble quite a bit when they do things like that. Don't be afraid to ask questions. You don't want to feel pressured when you make your decision. Sometimes realtors will push you into a particular property, like, oh, we need to make an offer right now. If we don't make an offer, we're going to lose the property. Well, if it's not meant for you, it's not meant for you. Don't rush. You don't want to be uncomfortable and end up buying something that you'll regret later. And then the last but not least, do not, when you're purchasing a home and you're in the buying process, do not open additional credit cards. Oh my God, I can't tell you that enough. Do not mess with your debt. Don't get yourself a new Ferrari. Don't do any of that while you're in the process of purchasing a home, because that can affect your debt to income ratio, and we can go from approval to denial real fast. All right, we'll go to the next one, Davina. What to expect from your lender. So your lender, like I was telling you, is going to help you to decide, to help you to see what is quote unquote affordable as far as what your debt ratio or what your monthly income will allow. So typically, when it comes to qualifying for a home, if you're over 45% of your income is going towards your mortgage and the rest of your expenses, after 45, it starts to red flags start to pop up. So your mortgage banker will be able to help you to see, based on your income and and the debts that are appearing on your credit report, what you qualify for. We can go on to the next one. We can, like I said, we get deeper to that when you actually reach out to me and we figure it out personally. So this is what to expect from your lender. Some of the costs that you can expect to incur: processing fees, title fees, application fees. As you can see, there's a lot of money that kind of goes into the purchase process. So that's why it's so important and it's so critical right now, and it's so just awesome that we have all these down payment assistance programs that will help you with not only your down payment, but these costs that can be associated with it as well. In my 20 some odd years of mortgage banking, This is one of the best times as far as help, financial help for homeowners. We can go to the next slide. Couple different types of loans that you're going to run into. You've got fixed rate loans. That's where the rate does not change for the life of the loan. The interest rate stays the same. You've got adjustable rate mortgages. These are programs that usually have lower interest rates for the first 3 or 5 years, and then they go to an adjustable. They can be tricky, so you got to be careful. There's only certain people that I like to put in those types of programs. Then you also have FHA loans. FHA loans are loans for people who may not have a whole lot, maybe a first-time home buyer, may not have a whole lot to put down. Maybe their credit was bruised in the past, things like that. The FHA loan is a good loan. And then, of course, you've got the VA loan for our veterans, which is also a good product. So those are just a couple of the many programs that are available. We can go ahead to the next slide. Things that you can do to get started today. Make sure you continue to pay your bills on time. Inspect that credit report to see if there's anything on there that you should remove, or any marks that could hurt you down the road and prevent you from being able to get qualified. Save for a down payment. If you don't have a lot of money, that's okay. These, like I said, these down payment assistance programs are great. You want to gather your financial information, your bank statements and stuff like that. And if you can, and in most states it's available, take yourself a home buyer education course, which is sort of like what we're doing today a little bit. We're kind of integrating both the wealth building piece as well as education. So you can go ahead to the next slide. So this is just a flyer that we give to a lot of people, and you can always reach out if you have questions. You can fill this flyer in yourself, and it kind of tells you how much you can afford, how much of a home you can afford. If you guys want that flyer, just let me know, and then we can make sure we get it out to you. You can go to the next slide. So like you said, step 3, of course, getting yourself pre-qualified to start the mortgage process. We walk you through that. We walk you through the steps. These are the things that we typically need during the mortgage process: Social Security card, driver's license, W-2s, pay stubs, things like that. Good mortgage banker will be able to walk you through all of that step by step. Go ahead to the next one. And then last but not least, call the movers, pick up the keys, and you're into the new house. You can go to the next one, Davina. Jay, I'm gonna kick it to you for this one.
Thank you, sir. So thank you, Nigel, for that. And as Nigel mentioned in his comments, you can keep going, Davina. So on your personal financial statement, and most people don't walk through this exercise. I actually have a program where I walk you through the exercise of completing your personal financial statement. Keep going, Davina. And what you'll see on most people's personal financial statement, AKA personal balance sheet, is that your home is your largest asset. At least a lot of times it starts out that way, right? And you can leverage that home, like Nigel said, to do so many other things once you begin to build equity, because that equity becomes a real asset for you in your wealth building strategy. It is, and as you pay down or off your mortgage, it becomes a real leverageable asset for your personal wealth building strategy. Happy to talk more about this. I know that we're coming close to, if not over, or at our time. But one of the things that I wanted to mention before I turn it over to Q&A is one of the biggest mistakes that I think many people make in the wealth building, on the journey to building wealth, is over leveraging, and over leveraging yourselves with car loans, over leveraging yourselves with more home than you can afford. One of your biggest wealth producing assets is your income, right? In your ability to leverage your income to build assets is going to be the primary way to build your wealth. And one of those primary options, or one of those primary opportunities, is through home ownership, where you could then use to leverage even further. But you gotta, at the end of the day, you gotta live off less than you make, right? And begin to build those assets on the green side of this balance sheet in order to build your wealth. Next slide.
I
right.
want to pause. He didn't respond to the chat. Jimmy Webster, I think his last name. You had a raised hand. Did you want to ask that question now or wait? You can put it in the chat if you can do that.
Yeah, we can open it up to Q&A at this point too, if you want, Derek.
Let me see if I can get him to come off mute. Maybe that might be the fastest.
Well,
He asked it in the question. He said, is it a good time to buy while the interest rates are high?
I'll take that one. That's a good question. So here's, for people who are kind of skeptical about purchasing a home in this particular environment, yes, interest rates have gone up. They are higher than they've been, in quite some time. But I tell people all the time, you marry the house, you date the interest rate. When the rates do come down, and rates are cyclical, they will come down. When they do, we'll take advantage of refinances. Right now, for instance, Fifth Third has a program where if interest rates drop within a year of you purchasing, you're able to refinance at a substantially reduced cost to you. So you don't want to pass up a wonderful opportunity just because interest rates are a little bit higher right now, because they won't be like that forever. They're cyclical.
Can I also pose a question for someone? This is Charles.
Go ahead.
Absolutely.
Okay, the questioner is listed as anonymous, but the question is, if you are expecting to earn more money in the future, why shouldn't you buy more home than you can afford on your present income?
That's a good question. So some people do, in fact, take advantage of that particular situation. We've actually got loans for that. For instance, we've got what's called a doctor program. It's a program that allows, if you're in your residency or you're approaching your residency as a physician, to be able to purchase a home beyond what their normal debt to income ratio can handle, because there is an assumption, a reasonable assumption, that after their residency, they will be making substantially more. So in certain cases, it does make sense to be able to to purchase something that may be a little bit uncomfortable, if you know for sure that your income will be increasing.
Okay, are there any rules of thumb in terms of how much pain is a reasonable amount? I mean, relative to future expectation, or is it a fly by night?
Can I jump
So
in there before you answer that one, Nigel?
Sure.
Going back to the original question, while the gray hair on my face is forcing me to answer this question the way that I am. Just because you can do something doesn't mean you should do something, right? So I would say the expectation of future earnings, while that is a good thing, and by all means, pursue your dreams to the hilt, but live off less than you make today. You can always buy the house of your dreams when that payday does come through, but don't set yourself up for unnecessary pain of getting too much house too soon, to where you can jeopardize your ability to build that wealth. That's the gray haired me talking.
Okay.
That's great advice.
Can I pose a few other questions in the chat?
Fire away.
Absolutely.
Okay, Carl Berkeley asked, I have a lot, all caps, of college debt, how would that affect my DTI?
Good question. So if what we typically will do, if that debt is currently not being paid right now, if you have it deferred or what have you, what we do is we will take the total of that college debt and we will use 1/2 of 1% of that debt as the proposed or estimated monthly payment for that debt. For instance, let's say if you've got, let's just say if you got $150,000 in debt, times 0.5%, we would estimate the payment on that debt to be $750, and that's what we would use against your debt to income ratio. And that's how lenders will calculate that student loan debt, even if it's currently deferred, because they figure within a 15-year or 30-year mortgage, you're going to eventually have to start paying it back. And that will give, so we use that 1/2 of 1% rule.
Okay. Next question from Melvin Thomas. Should you have about 3 months of emergency living expense saved before you purchase a home?
I mean, that's a great rule of thumb. I mean, some rules of thumb are even say you want to have 6 months. Is it a must? No. Do we require it as a lender? No. There are some programs that are available that do say, hey, you have to have some reserve assets. But by and large, like for instance, that FHA program that we were talking about, conventional loan financing, a lot of times they don't have a requirement for expenses after after your loan closes. They used to be like that a lot. There used to be a requirement where they want to see 6 months of reserves or 3 months of reserves. That's been thrown out a long time ago.
So what Nigel is presenting you guys with is what you need to qualify. I'm presenting you with what you should do, regardless of whether or not you qualify. So going back to the prior question, a lot of student loans. What is that going to do to your debt to income? Yeah, it's gonna affect the amount of house that you can buy. Should that affect your ability to buy a home? Not necessarily. I would say try to get rid of that student debt as quickly as possible. And then on this second question, I forgot what the second question was. What was the second question?
About the emergency funds.
Oh yeah, emergency fund. Yes. Thank you, Brother Charlie. Yeah, emergency fund. It is prudent to have 3 to 6 months of expenses saved in an emergency fund for emergencies. As we all know, we are in a really fickle economic environment right now, where folks is leaving jobs and quitting jobs and getting fired from jobs. So the income that you have today may or may not be the income that you have tomorrow. So if you have that emergency fund in place, you won't be at risk of losing your home right away if you have that emergency fund in place prior to going in and buying your home. So yes, I would recommend 3 to 6 months of expenses in an emergency fund. An emergency fund that you do not have easy access to, so maybe something like a money market account or something like that, where you don't have easy access to, but it's liquid enough where if you do find yourself in an emergency, you can get to it right away. And when it comes to wealth building, protecting yourself against emergencies is one of the major ways in order to keep your plan on track, so that when you have an emergency, you don't also have a financial problem.
Would you prefer to go back and finish your presentation or take these remaining questions?
I like the question.
Oh no, the presentation for the most part is pretty much done, so we can knock out questions.
Okay, I'll try to handle them quick. I'll try to handle them quickly. Is it a good idea or not to buy in a community with a homeowners association and covenants?
Okay. So homeowners association and covenants. So what that does, so we're talking typically talking about like condos or it might even be what's called site condos, which are actually regular homes, but it's
Hmm.
still under an association. There's nothing wrong with it. There's absolutely nothing wrong with purchasing, home with that. What you do want to make sure of though is that the financial fitness of that particular association is there.
Good
When I
point.
say financial fitness, what we're talking about, there are a lot of associations out here where people may be delinquent in their dues. So what that means is they don't have the money to be able to do the things that associations are normally supposed to do in order to function. Things like if there are roads inside of the community that are maintained by the association, or if there are parks that are maintained within the community by the association. If they don't have the money because they're not getting the influx of homeowners association dues, then those things can go into disrepair, which can pull down the desirability of that particular property or that project or that area. You know what I mean? So financial fitness of the program of the is key.
Can you
I
can
would
you give
agree
me
with.
can you give me 30 seconds on how to uncover that information?
So a lot of times, what you can do is you can talk to the homeowners association. So the same way, your realtor can get you the information, the specifics for the property itself.
Mhm.
They can also get you the information, financial information in regards to the association. When lenders like ourselves go to finance condominiums that have association fees and associations, what we get is their financial statements because we have to make sure that if we're going to invest in this particular condo for this person, that the association is strong enough to be able to maintain the external amenities of the property. So a lot of times, it's a requirement for us when somebody's buying a condo that we get that financial information, but you can request it or your realtor can request it before you even make an offer.
And to double click on that, um, so I live in a neighborhood with a homeowners association, and part of the duty of the association is to maintain the common areas around the property, and to maintain um, the aesthetics and keep homeowners in line with what's going. If you don't plan on keeping your property up, don't live in one of those because they're going to be on you to keep your property up. And two, make sure that you understand the dues of the homeowner association. I'm not sure about the covenants. I don't know that I've ever heard of a community with covenants, but make sure you understand what the dues are for the homeowners association. I've heard of homeowners association whose dues are are greater than the mortgage payment on the homes in the association, which to me seems a little bit ridiculous. But be that as it may,
Yeah,
be
homeowners
sure that you
association dues
understand
have
what it
been on
is.
the rise, since the pandemic and things as well. So, perfect example. I've got a guy who's looking at purchasing a very modest one bedroom condominium. I think the asking price is only like 80,000. So we're kind of going through everything, and I'm like, okay, well, what about the association? He tells me the association is $427 a month. I said, man, if you don't get out of there and stop looking at that, I said, that's going to be more than that's going to be more than half of your mortgage payment. So yeah,
Yep.
association, you got definitely ask the right questions because sometimes what happens is when the association is in trouble, what they do is they lean on the people that are paying a little stronger. So in the form of higher association dues for the ones that are paying.
Could I also make a somewhat informed comment that if you're going to move into a community like that, you should strongly consider trying to get on the homeowners association
Absolutely.
board, or at the very minimum, attend the meetings.
Absolutely. I couldn't agree more.
Okay. Let me get to another question. Um, where did it go? It was posted anonymously. He was asking, can credit relief specialists indeed offer beneficial service, or is it best to leave them alone and work directly with the creditors?
So in regards to, give me 1 second, just want to answer a client.
So while you're
In
thinking
regards
about that,
to
night,
those credit specialists, you have to be careful. There are some very, very reputable organizations. For instance, here in Michigan, Jason and I work with quite a few very reputable nonprofit companies that work to help to repair the credit. They have, all types of different offerings in regards to credit repair, things like that, and a lot of them are free of charge. Um, but on the same token, yes, there are some of those fly-by-night companies that will promise you the whole, the moon and stars. You give that, they say, okay, just give me $400 and I'll wipe your credit clean or something crazy like that. Those are the ones that you kind of want to stay away from. Some of the nonprofits, you can also look a lot of these companies up on the Better Business Bureau, kind of get an idea of their particular track record. Yeah, all of them aren't shysters, but you want to do your homework.
Hey, Nigel, this is Derek. I would also add, while I spoke earlier about the balance program, specifically about the credit report, they do a holistic evaluation on you.
Mhm.
And again, this is at no cost to the members or the fraternity because we have made that as a service. I would say before you go and purchase an advisor, go through the balance program, hear what they have to say, get their feedback. And if you still have questions that they can't answer and you feel as though you need to go invest funding, then do that. But this service is available to you to ask those kinds of questions and they would do some analysis with you on your specific need.
Okay, now real quickly, does bankruptcy kill all chances of loan approval?
When it comes to qualifying for a mortgage, the most bankruptcy friendly program is usually the FHA loan. And as FHA loan requires that you have been discharged from the bankruptcy for at least 24 months. So depending on the type of bankruptcy that it is, if it's a Chapter 7 where they wiped you clean, then you've got to wait. You need to be 24 months out of since it's been discharged. If it's a Chapter 13 where it's the reorganization of your debt, not the complete absolving of your debt, then they say 24 months since you started that particular reorganization of debt. So as a rule, 2 years.
Okay. Those questions were posed by Colby Fontenot. Next,
can I add to that real quick, Charlie?
of course, of course.
Before you jump back in there, be sure that whatever caused you to have to file for bankruptcy, make sure that that has been resolved, whether that is a behavioral thing or an emergency that you really couldn't work your way around outside of a bankruptcy. Make sure that whatever caused you to have to file bankruptcy, make sure that's been resolved before you go into more debt.
Okay. And then Brother Berkeley first sends a shout out from Alpha Delta Phi Spring 18 with his thanks for all the answers. But he also asks for contacts in the New Jersey area for Omega men in the finance field who can assist him one-on-one on his home ownership journey. So if anybody can grab his contact information and maybe follow up after the webinar and make some contacts and connections for him.
Okay. So this is recorded. So if we don't get anybody here, we have at least the question and we'll go through the recording and do some follow-up. I would recommend we take 2 more questions and then we summarize everything if there are 2.
Okay. Then this one from an anonymous attendee, what percentage of your income should you look to pay for a mortgage?
Oh, I'm sitting there I was sitting there typing his answer for him.
I'm sorry. Go ahead. Go ahead.
So basically, your debt ratio, usually before the red flag goes up when you're at 45% DTI. Now that 45, so that's basically 45% of your income is going towards not only your mortgage, but the rest of the expenses that show on the credit report. So what you want to do, perfect example, let's say if you make $10,000 a month. So if 45% of 10,000 is 4,500. So $4,500 should be able to not only cover your mortgage payment, but also the rest of the debts on the credit report. So that's the car payment, the credit
Okay.
cards,
Student
any
loans.
student loans, things like that.
Mhm.
So
Anything more than that is way too much.
anything
I
more
like
than
the
that,
rule.
it starts to be a red flag, and it starts to get a little uncomfortable for the buyer.
It gets more than uncomfortable. I like the rule of thumb, 20 to 25% for housing.
Okay, great enough. Last, and this is selfish because I'm asking this question. Does Fifth Third have, or are you familiar with any other lender who has a program that allows a borrower to, let me say, swap student loan debt for mortgage?
Nope.
Okay.
Wait, say
Yeah,
that
I've never
differently.
heard of a program that allows you to just swap that.
Okay.
So are you saying, can you potentially take out a home equity maybe, or refinance a home to pay off your student loan debt?
And I asked because this was introduced to us in one of our meetings that there are some programs or a program that allowed someone with student loan debt to trade that in, if you will, for a portion of a mortgage to just roll it into a mortgage payment. But don't belabor it. If you're not familiar with it and Fifth Third doesn't have it, just pass on this one.
Yeah, that sounds like a refinance where you're taking equity out to pay off a student loan debt. That's what it sounds like.
Okay. All right. Good enough. Back to you guys because I think we've exhausted all the questions in chat and Q&A.
Thank you, Brother Bruce.
All right.
I'll let you go first, Davina.
Okay, well, really good questions, of course. Contact information for our speakers, but we will send the recording out and we can add this information there as well. If you check the chat, they had provided some great resources to us. So there's two different flyers that you can download. So go ahead and click on the chat and download that for more information. And then as well, this was just the first in our 3-part series. So we will be meeting again next Wednesday. We're talking about credit, the credit portion in your wealth building strategy. And it's actually a soror from my chapter from Prudential who'll be speaking about that. And then we'll be wrapping it up 2 weeks from now on the 23rd with just talking about building the foundation in general for financial freedom with Curtis Baylor, who is on the marketing chair on the credit union. And then any other questions, feel free to reach out to us post this webinar.
Hey, Davina,
Yes.
this is Norris Middleton.
Hi.
You told the folks how to, the information is in the chat. Should let them know how to go about saving it with the 3 little dots there in the chat. Because in other words,
Oh, okay. Well, yeah, you can open it and then download it, or you can double click it and it'll open in like a Adobe Acrobat Reader kind of thing, and then you can save it from there. Thank you for asking.
okay.
Appreciate it. All right, Derek,
thank
I'll
you.
turn it back over to you.
Thank you. And 2 thumbs up to Nigel and Jason. We appreciate you guys being here. Thank you, Davina, for helping to pull this together. We look forward for all those in attendance to come back next week. We'll work on getting the recording posted. We'll put it on our website so that way it's widely available to all of you here as well as others. And we'll go through it. If there are any other questions that we may have missed, we will make that available to you. As part of sending questions, if this is real easy, the word webinar, WEBINAR, at OPPFFCU.com. So if you have any questions related to this webinar or any of the other 2, If you send an email to that email address, it will get routed to someone, and then we can collect it accordingly. We greatly appreciated you guys attending. This was our first one. We'll look at putting together a survey to solicit some feedback as to how well you thought this went and what might be of interest to you in the future and what we could do better. But I am very pleased that of your attendance, your participation, as well as to our presenters. Thank you so much.
Thank you for having us.
You're welcome. And on that note, everyone, I will conclude this webinar and appreciate you guys hanging on. We had approximately 39 tops that attended. So that was a good participation. Appreciate it.
Perfect. Thank you, everyone.
Thanks, everyone.